Well, good morning, everyone, and welcome to this webinar that we're holding in association with the Pension Protection Fund. I'm just going to give a few seconds for you all to filter into the webinar, and then I'll begin in just a few seconds. So good morning and welcome once again. Well, hello and welcome once again to this webinar to discuss the PPF's annual Purple Book. A webinar Professional Pensions is delighted to be holding in conjunction with the Pension Protection Fund. My name is Jonathan Stapleton. I'm the editor of PP and I will be your host for this session. The PPF's Purple Book, as I'm sure many of you know, is an annual survey of scheme finances that paints a holistic picture of the risk posed by UK defined benefit schemes protected by the PPF, giving an idea of the latest trends in scheme de-risking, asset allocation and membership, among numerous other areas. This webinar will be your chance to find out about the most recent edition of the Purple Book and put your questions to a number of speakers and panelists from the PPF. I'm delighted to welcome our speakers and panelists today. We have PPF Chief Actuary and Interim Chief Financial Officer Shalin Bhagwan, PPF Actuary James Emmett, PPF Head of Actuarial Financial Management Aaron Pang, and PPF Actuary Maria Graney. Welcome to you all. Before we hand over to Shalin and James to present some of the highlights of this year's Purple Book, I was just hoping to ask each of our speakers and panelists to tell us a little bit more about who they are, what it is they do. Shalin, can I start with you, please?
Yes, thanks, Jonathan, and good morning and welcome to this webinar. Thank you for joining us. As Jonathan has mentioned, I am Chief Actuary and Interim Chief Financial Officer here at the Pension Protection Fund. I joined the Pension Protection Fund in the summer of this year, having spent 2 decades in investment management, most notably in the field of liability-driven investments and credit. Prior to that, I worked for an insurance company in South Africa, doing pensions and insurance work as an actuary.
Thank you very much indeed. James, can I come to you next, please?
Thank you, Jonathan. Morning all. My name's James Emmett. I'm an actuary here at the PPF in one of Shalin's teams. I've been here about 6 years, and this year I led the production of the Purple Book. Prior to my time here at the PPF, I was in consultancy for nearly 10 years, not quite, but nearly. And during that time, I remember looking at the Purple Book quite a lot.
Thank you very much indeed, James. Aaron.
Hello, everyone. I'm Aaron Pang. I'm Head of Actuarial Financial Management. I've been at the PPF for a long time, so I've been here for about 15 years. And so I think the reason I'm on this call is because I've been working on Purple or been involved in Purple for all of that time. And so I'm here really to help answer any questions about perhaps previous Purples or anything about the trends that have been happening. Thank you.
Thank you. Thank you very much indeed. Last but not least, Maria.
Hi, everyone. I'm Maria Graney, and I'm an actuary here at the PPF. I think, like lots of us, I formerly came from consulting. This year, I'm here because I've been heavily involved in both the production of the data and the analysis for the Purple Book itself.
Thank you, Maria, and indeed, thank you all. As mentioned, we're going to begin with a presentation by Shalin and James on some of the headline findings of this year's Purple Book. But before I hand over to them, just like to remind you, this is an interactive webinar. So if you have a question to put to any of our speakers or panelists, please do type it into the Q&A box on your screen. I'll put those, as many of those as possible, to our panel in the Q&A part of our webinar later on. Now, without any further ado, I'd like to hand over straight away to Shalin and James for the presentation. Over to you. Thank you.
Thank you, Jonathan. And so diving straight into the Purple, unlike my good self, the Purple Book, being in its 18th year of production, needs absolutely no introduction. It continues to be one of the most well-thumbed pensions publications in the UK landscape. I, for one, in my time in asset management, spent a long time studying the Purple Book for its key trends and insights. Most importantly, For all of you, Purple provides you with an insight into the trends in defined benefit scheme funding, as well as the demographics and asset allocation trends within that universe. For us here at the Pension Protection Fund, it provides us with great insight into how the risk of that universe is evolving over time, and therefore provides us with insight in terms of how we think about protecting the almost 9 million members that the PPF has been set up to protect. Many of you will be familiar with the PPF 7800, which is a more frequent update of funding trends in the DB landscape. The Purple Book is the starting point for that index, and the PPF 7800 rolls forward results which emanate from Purple. Next slide, please. So I will kick off with some main messages, then hand over to James for the bulk of the presentation before returning to talk about the PPF's own funding position and funding strategy. And at the end, as Jonathan has already mentioned, we'll be joined by Aaron and Maria for Q&A. So looking at the main messages, it's not going to surprise you that once again this year, the trend has continued in terms of an improving funding position and the continued de-risking of UK defined benefit pension funds. Obviously, the notable trend following on from the autumn statement last year is the spike in gilt yields, which has driven liability values down and has seen significant increases in, I stress, aggregate funding ratios. And whilst we refer on this slide to a significantly improved Section 179 funding position with potentially a surplus on that position, as well as a significantly improved funding ratio, we are always cognizant of the fact that the aggregate figure glosses over a slightly more nuanced picture when it comes to individual defined benefit pension funds, and we know that a rising tide has not necessarily lifted all boats. I think furthermore, simply demonstrating an improved funding position on a Section 179 basis needs to be seen in light of the fact that pension funds are aiming to pay benefits at a much higher level than would be implied on that basis. So we are cognizant of that and are mindful of that when we think about how we protect the universe. In terms of the DB scheme universe, it's not going to surprise you to know that no matter which way you cut the data, and in the top right-hand corner here, we've given you some statistics which cut the data in a particular way. The defined benefit pension fund remains an extremely fragmented universe. Some 4,000 to 4,500 pension funds account for roughly £200 billion of assets. And so, in a universe of just shy of 6,000 pension funds, that is, quite a disparity in terms of the largest pension funds and the much smaller pension funds. Again, we've seen the number of schemes reduce in our universe as schemes have wound up or merged, or indeed gone to buyout, which a point I will return to later when I give you key trends on buyout later in the presentation. Proportions of assets invested between equities and bonds have remained fairly stable, although I would again point to the fact that the data collection that we have for Purple, and James will come onto this as well, does have lags within it, and therefore it influences the next point I was going to make, which is that whilst you will notice that the proportion invested in UK equities continue to fall, you might notice that the proportion invested in private equity rose. Again, there's potentially some lagged effect from valuation effects not having fully reflected in asset values. So with that, I will pause there and hand over to James.
Thank you very much, Shannon. Thank you to Jonathan, Professional Pensions, for having us, and for all of you for joining. So I'm going to be talking a bit more about some of the detail the Purple Book, and it seems odd to pause before I've even started, but I would like to pause with just a few important sort of points on data, just to make sure so everyone's on the same page with this stuff. And Shannon indeed mentioned something of a lag in our data. What that refers to is, so the source of our data is the scheme returns submitted by schemes to the pensions regulator. For the Purple Book 23, that would be those submitted by March 23 this year. Within those scheme returns, submitted Section 179 valuation data. That is the starting point for our assets and liabilities. But those valuations are not as at 31st of March 23. They are from 1, 2, 3 years ago and older in some cases. The statistic is that 2/3 of those valuations in the scheme returns are from April 2020 to March 22, and a further 30% are older than that, i.e. before 2020, which only leaves, I think, less than 5% more recent than March 22. What is provided in the scheme returns is a later asset allocation. Those come later than the scheme, than the 179 valuations, and around 95% of the asset allocations are from April 21 to September 2022, so a little bit later in those cases. Lots more on data can be found in chapter 2, which is a dedicated data chapter of the Purple Book. One thing I did want to say was, as well as the scheme returns, we supplemented it a bit by writing out to some schemes to ask for information on LDI exposure classified as bonds in the asset splits in the scheme returns. I wrote to some 350 schemes, got lots of responses and plenty that I was able to update the data with. So incredibly useful, and I would just like to thank again those schemes and advisors that engaged with us on that. When I say methodology, as I do in the bottom right hand corner of this slide here, I'm talking about mostly the roll forward that we do to get from those old 179 valuations up to our common date, so we can show everything in aggregate at a common date. So our roll forward methodology is approximate in nature, it's simplified. It matches that used for the levy, as you can find in the levy determination transformation appendix. And again, our own appendix in the Purple Book at the back of the publication can tell you more. Next slide, please. Oh, thank you, Sophie. So with that, I'd like to start properly, but talking with this theme of the universe of schemes continuing to mature. Now, that concept is not a surprise, I wouldn't imagine, to most of you on this call. So it's not a message I'm going to dwell on for that long, but I did want to highlight some of the statistics that we've got around that. So the starting one on the left there, in terms of PPF eligible schemes in UK DB universe, 5,063 is the number of schemes this year, and that's 68 down from last year's 5,131, which is the smallest decrease over a year in number of schemes in absolute terms. The number of members, on the other hand, is more of a sharp decline from 9.6 million last year to just under 9 million, 8.9 million number of members in the eligible universe this year. And that reflects various things like, well, there's data true up, as well as things, schemes winding up, coming into PPF assessment, or members dying. Next slide, please. So the top graph on this chart, headed scheme status. By scheme status, I'm talking about whether a scheme is open completely to new members and new accrual, whether it's closed to new members but still open to new benefit accrual, or whether it's closed to everything, closed to new members and closed to new benefit accrual. So the purple bars at the bottom are the open schemes, and then fully closed at the top, with a little bit of winding up, sort of just peeking out the top there. You've got a history from 2006 to now. You'll see a bit of a space saving measure on the left. 06 jumps to 11, jumps to 16, and then from 16 it's every year. We did that in last year's webinar, and we've also done it in this year's Purple Book. to save some space for the history, to fill those gaps, feel free to refer to Purple Book 2022 or earlier. So what that's showing is again sort of a continuation of the trend. Proportion of open schemes is now single figures for the first time, dropped down to 9% there, and close to new benefit accrual is well, still above 50 and 1% more, 52% compared to last year's 51. That's that closure to new benefit accrual. If you compare that to 2006, it's fairly steady, 2-3% a year. Schemes to in those early years, trend much shallower. So I would just like to point out that I understand colleagues at the pensions regulator reviewing how the questions on this are answered and we may see more of a shift in some of these proportions. And then the second chart here, that 7 and didn't have as much up 23, and at 2023 you'll see of liabilities in respect of pensioners is over 50% for the first, about 54%. Okay, thank you. Next slide, please. Okay, so here we show the university's Section 179 funding position as at 31st of March 2023. Just as a reminder, Section 179 liabilities represent broadly what would have to be paid to an insurance company to take on PPF levels of compensation. So that's instead of full scheme benefits, and 179 is the thing we use for levy. Excuse me, pardon me. So that's where we get that from. You'll notice a little number there, 5,051 in the top left of the screen. That's 12 fewer than the 5,063 quoted earlier. So this is the purple sample. It's only 12 schemes didn't quite pass the data validation in time, so didn't make it to final inclusion. But that still represents 99.8% of the eligible scheme universe. So you'll see that as at 31st of March 2023, 84% of schemes estimated to be in surplus, 16% in deficit, with a deficit of 8 billion, compared to an overall running position of 359 billion surplus. That represents 134% aggregate funding ratio, up from 113% the year before. The year before, the deficit of schemes in deficit was 61 billion, which compares to that 8 billion on screen. That 134% is something of a record high, not allowing for some more volatility in the 700-800 in the year in between purple books. And it was nearly in that plus 21 percentage point improvement in aggregate funding ratio over the year is primarily due to market movements, although about 1 percentage point, 1.1 percentage points of that 21 increase was to do with updating to the new data set using Purple 23, updated from 22. So that was at 31st of March 23. The 7800 has been rolling on since then, and indeed next week publication of 7800 will roll up to November, and that'll reset onto the new purple data. So in the sort of the data history on the website will be retrospectively updated from March up to November to be based on new Purple 23. I quote the 31st of October figures here. Since March, 15-year gilt yields, just as an example, have gone up by 1.1 percentage points, leading to asset values dropping by 7%, 179 liabilities, values dropping by 14%, funding ratio up to 146. Now the deficit of schemes in deficit is still 8 billion, but it's important to point out that it's a different 8 billion to the one at March, a different set of schemes, and have behaved differently and rolled forward differently to the other set. But yeah, 8 billion dosed for short, as we say, and that's from a 12% of schemes being deficit. And oh yes, and one other thing I should point out, another driver of change between March and October is that 31st of March for Purple Book and the 7800 up until May were based on the A10 version of Section 179 assumptions, changed over in May to the A11. So the 7800 will reflect A11 from May onwards, and for example, that's in the October figures there, and that had about 5 or 6 percentage point improvement in funding ratio. Next slide, please, Sophie. Okay, so my next and alas final section is on asset allocation, and the first of 2 slides here is the high level asset allocation. By high level, I mean equities, bonds, other. That really top level view. And this chart shows you again a history from 2006 with the space saving, and then 2016 up to now. Equities in purple, bonds in blue, and other in grey. What strikes me about this is that if one were to round to the nearest 5%, it would basically be 70-20 bonds to equities for the last 4 years, 4 or 5 years, say. So a real sort of stabilization in that split. And again, I should be clear that in the bond figure is not just the physical bonds in the scheme returns, but also the LDI exposure that has been inputted in the bond bit in scheme returns as behaves like a bond. So you've got bond and bond like LDI is represented in that 70% ish figure there. Okay, and my last slide on asset allocation, and this takes it a level down, well, for bonds and equities at least. And now the top chart there is my high level bond breakdown. There was several new bits of granularity and detail included in the scheme returns this year, and we have included a chart that breaks that down further. That chart is quite detailed. It's in chapter 7 of the Purple Book. Pardon me, excuse me. But it is a little detailed to perhaps have shown here. But like I said, do please see it in chapter 7. So what I show you is the breakdown between gilts, corporates, and index-linked gilts. And sort of perhaps the main message from 2022 to 23 is the 6 percentage point increase in corporates, offset by decreases in the others. For the equity breakdown, which is the second chart there, so for 2008 up to 2022, it's as the breakdown was in terms of UK quoted, overseas quoted, and then unquoted or private equity. 2023 introduces some of the new granularity available in the source data. Now it's basically, well, you've gone from a bar of blue to sort of a bar of 3 sort of different kinds of blue. So I'll just talk those through quickly. And one other point that within that is assets are now, we talk about tiers, tier 1, tier 2, tier 3. That refers to scheme returns and how schemes are classified depending on the size of them. If you're tier 1 scheme, then you wouldn't have submitted the extra granularity. Tiers 2 and 3 would have. So that 1% in 2023 that you can probably not even see is for tier 1 schemes, their share of overseas equity 2023. The 54% is tier 2 and 3 schemes, which is most of the assets. Not tier 1 is a lot of schemes, but not very much in terms of aggregate assets and liabilities. But the 54% is overseas equities held in developed markets, and then the 8% picking out the top of that group of 3 is the emerging market overseas equities. But again, I'll refer you to chapter 7 for more. So thank you very much. And I'd like to hand back to Shannon for the next section.
Thanks, James. That was brilliant. So on this slide, what we are showing you are the three phases of our journey as the PPF, and it's a stylistic representation of how we think about the three phases of our journey. So those three phases are the growth phase, the maturing phase, and the runoff phase. And the line that you see drawn across those three phases is, I guess, a stylized representation of assets, liabilities, or reserves, or some combination of all three. And intuitively, you can understand the three phases by simply looking at the line, which, as you can imagine, during the growth phase, we expect that as we are receiving more claims, our liabilities are growing, our assets are growing, and we are also growing our reserves through a combination of investment return and levy. Once we reach the maturing phase, it becomes about maintaining resilience, because in this phase, we are seeing claims beginning to taper off. Therefore, our liabilities are not growing as quickly. And in fact, with good fortune, claims continue to diminish in this phase as we reach the end of this phase. And therefore, we begin to approach what we refer to as the runoff phase, where outflows exceed inflows in terms of not getting many more claims, and we are paying more benefits. And therefore, in the runoff phase, we hope we have built up sufficient resilience in order to be able to protect the schemes that have transferred to the PPF, as well as the schemes that are still out there. But as I said, in that phase, the runoff phase, we expect claims to be very low. Expanding on the phase that we find ourselves in currently, which is we consider the maturing phase. On the next slide, you'll see that the objective here is to maintain our financial resilience. How do we think about financial resilience? Well, we hold reserves against two primary risks, and those risks are the risks that people live longer than expected, and therefore that's a longevity risk, what we call our priority one reserves, and also claims risk, the risk that more pension funds enter the PPF. And those reserves, priority one and priority two reserves, are funded from our levy collections as well as investment returns. Anything above priority one and priority two reserves would be regarded as additional protection, and the intention there would be to fund those primarily from investment return, focus on minimizing our downside risk, but certainly look to, as I said, fund those from investment return rather than levy. And I think that experience is being borne out with the reductions in levy that we've seen over the past few years. On the next slide, this is an update of our reserve position between 2022 to 2023. And as you can see, our reserves are just north of 12 billion. Again, that relates to holding monies which are provided to protect against those contingent events I referred to on the previous slide. I'd like to explore one of the larger elements of that reserve figure on the next slide, which basically shows you the projection. Well, it shows you the history of claims going back to 2018 in the red or cerise line, and then projects forward claims, and you can see the mean projection is, I guess, fairly benign, certainly by historical standards. And what this chart shows is that despite the mean projection being benign, we hold reserves to protect ourselves against some of the more adverse outcomes that may occur around that mean outcome. And this effect, what this chart shows is that there is the possibility of the PPF being called upon to pay large claims in the future. The outlook is not, as much as the outlook has improved significantly, it is not totally without risk, and that's the reason we hold reserves. And so changing tack ever so slightly, the next page really relates to, again, the evolving risk within the DB universe. And as pension funds have been fast approaching their end game, Purple also provides you with an overview of what is happening in the market for risk transfer. And it's no surprise to know that the last 4 or 5 years have been record years for the pensions risk transfer market, and 2023 is shaping up to be a similar year. We've got H1 figures on this chart, and we've all seen a flurry of buyout deals that have been announced in the second half of this year. So, as we look in the run up to Christmas, and certainly we'll see some numbers probably early next year, there's no doubt that the pensions risk transfer market continues to be a well-supported market in terms of defined benefit pension fund end games strategy. And that brings me to the end of my section. I will hand back to Jonathan for the Q&A.
Well, thank you very much indeed for that, Shallon. Thank you also, James. We've had lots of questions coming through, so thank you very much indeed for sending all of those through. We'll try and put as many as possible to our panel. If you keep them coming in, that would be great. Just type them into the question box on our screen. I'm going to take us with an administrative one to start with. Will the Purple Book be available on the PPF website, and when will it be released? As far as I understand, it'll be published today at 11 AM and will be available on the PPF website. Is that correct? Super.
Yes.
Thank you very much indeed. Thank you very much indeed, Maria. That's absolutely great. And I'll throw this one to Aaron. I know you're sort of answering this one during the Q&A. One with regards to the rise in pensioner numbers, or the rise in the percentage of pensioners in 2023 versus previous years. Aaron, do you have insights as to why that increased over the past year?
Yeah, I think there are two reasons for this. I mean, there is obviously each year we get new data, and so to some extent there are going to be a few. You'll get more members, and over time you'd expect there to be more pensioners. So that's a very small amount of the change. What's really happening here is it's this increase in gilt yields, and because active members, they have a much longer duration. When you discount those back, there's much more of an impact on your active and deferred members than your pensioner members. So pensioner liabilities then take up, don't decrease as much as your active and deferred liabilities. And so it's really a discounting thing rather than suddenly we've got, many, many more pensioners.
Thank you, Aaron. James, if I can come to you on that and just ask about the sort of profile actually of memberships of DB schemes. Obviously, the number of active members are decreasing. To what extent is there a cliff edge of deferred members? Are there sort of more deferred members that are reaching retirement age or close to retirement age? Are we going to sort of see schemes mature rapidly, as it were, over the coming sort of 5 or so years?
I think yes, we would expect such a thing, especially as schemes continue to close, fewer and fewer active members. So I think we would expect, as you say, that sort of aging and deferred average age gets older and each year. We don't have all the granularity in our data to say much more than that. We do have some average ages and then the profiles member numbers splits, but it is very much a sort of aggregate scheme level. So I don't think I can say much more at this point.
Thank you very much indeed for that, James. Coming to you, Shallon, the past year has seen a material increase in the net estimated funding position on a sort of full buyout basis. does this suggest to you that many schemes have accelerated towards their end games?
Well, I mean, I think that's right. I mean, I think one needs to be careful with the definition of end games, because I guess the term end game implies one final destination, which doesn't change as a result of changes in market conditions or the external environment. And I think what we need to take into account is that the last year has seen significant change in the market environment, not least of which is the rise in gilt yields. And I think it's natural for pension funds to question whether end games that they put into place a few years ago continue to be relevant given the changed market environment, and other developments. I guess when the facts change, you sort of entitled to change your mind as well. So I think I would just take approaching end game with a pinch of salt, in terms of saying let's people need to be thinking about what that end game is now, so more than ever.
Thank you very much indeed. Sort of allied a little bit to that, James, to what extent have the improvements seen in the past year been driven by rising gilt yields compared to other factors, for instance?
I think mostly is the short answer to that. So looking at the asset allocation again, so like I said before, the 70-20 sort of bonds to equity. So looking at the 20% equity, sort of an average with overseas and UK, the sort of equity values have stayed more or less the same, whereas liabilities will have gone down as gilt's gone up. So equities would have stayed the same, and then the asset gilt side will have gone down, but as modelled in our roll forward, not by as much. 7800 in purple is modelled as under hedged. So as gilt yields go up, all liabilities will go down. Liability values, I should say, will go down. The 20% of equity wouldn't have moved, and then the gilts went down by not quite as much. So largely from that.
Thank you so much for that, James. Coming to you, Shannon, another audience question here. Has there been an increase in schemes entering the PPF given the increase in corporate insolvencies this year?
Yeah, I think that whilst we've seen schemes entering the PPF, I would not describe it as an increase. What I would say is, when one thinks about corporate insolvencies, it is tempting to sort of extrapolate that to the defined benefit pension fund universe. However, the overlap between the corporate's experience, going through that distressed situation and having a defined benefit pension fund, that overlap, if you'd like, is the Venn diagram sort of doesn't overlap, and therefore corporate insolvencies are not necessarily a reflection that more pension funds are coming to the PPF. Yeah. Short answer is no.
If I may just add something, just to say that I think with improved funding ratios, even if a scheme does come to PPF assessment, at the moment it's more likely to perhaps seek to see if it can get a buyout quote or leave PPF assessment rather than transfer.
Thank you very much indeed, James. Maria, if I can come to you, this year you've received new asset splits in the scheme return data. What are your key takeaways from this new data?
Yeah, it's an interesting question, really, because the new data has given us a bit more insight into some of those larger asset classes. So really, how is the government bond breakdown? What does that look like? Same with corporates and overseas equities. So given I love data so much, it's actually been really interesting to have that wider sight of exactly how schemes are investing. I think the positive thing is it's really reaffirmed quite a lot of our expectations, which is always what you want to see. So when taking each in turn in the government bond space, we're seeing that the majority is invested in longer dated instruments. Within corporate bonds, the majority is within the investment grade space. And actually within overseas quoted, only a really small amount is within the emerging markets instruments rather than the developed markets. I think what I really am interested in is seeing, as we continue to collect this data in future years, how those trends then evolve. So, for instance, as schemes mature, will we see that longer dated gilt holding? Will we see that reduce? And who knows, maybe, you know, let's view it in the future, but 5-10 years, perhaps we'll be having a chat about Purple Book and talking about how the government's productive finance agenda and how that's really flown through in the asset allocations that schemes hold. So a little plug there to maybe join back in 5 years.
Thank you. Thanks very much indeed, Maria. Aaron, can I come to you? During the presentation, it's mentioned, and I find that perhaps a little bit surprising that within the equities allocations, there was a marked increase to private equity and a further reduction to UK listed equities. I presume that this was somewhat to do with the fact that the scheme illiquid assets sort of increased in proportion to a scheme's assets as a result of the LDI market turbulence. Is there more you can say on this, please?
I think there's a few things I can say, but perhaps it's worth looking at the slide. So, yeah, Sophie, would you mind looking at slide 9, please? Oh, is that slide 9? Damn it, then that's a different slide than I've got. Sorry, go one back, maybe? No, maybe one before. Damn, I don't know what slide it is. James, do you know what slide it is? Because I've got.
You want the one with the with the equity split?
Yeah, yeah. That one.
Okay, one slide on.
Ah, okay, yeah. I think there's a few things I should probably just say in advance. I mean, I think what you can see if you look at that table below is that this is not something new. I mean, that there's been a long-term trend where your UK quoted equities are falling, and you can see that over the 15 years, and your unquoted or your private equities have been increasing. Now, whether that is to do with the LDI crisis, I don't actually think that our data holds, the impact of the LDI crisis. So I wouldn't necessarily say that that's the reason why the private equity proportion has increased. What I would say, that it's obvious that it has been increasing over time, and perhaps more schemes are investing in those assets. I think in particular, something to note is that it really is the largest of the schemes that are generally investing in these unquoted private equities. And so, perhaps that's where they feel that they can get the return, and they've changed their asset allocations accordingly. I think we should also try to put this into context, because really we're looking at equities here. Less than 20% of the assets of the universe are in equities, and then we're talking about 30% of that less than 20%. So we're really only looking about 6%. So it would only take a few very large schemes to change their asset allocations, and then you'd get this result. So I think it may not be that the whole industry is moving towards unquoted equities.
Thank you so much for that, Aaron. Maria, if I can come back to you, to what extent would you, another audience question, to what extent would you expect an increase in fixed income allocations going forward, given the level of yields and bank rates sort of look like they have now peaked?
I think it's quite hard to predict the future. Obviously, here we're talking about the data and the trends that we've seen in the past. I think it's very interesting to see those kind of how those market indicators will change. And perhaps it's maybe a wider question that Charlene can help with.
Yeah, look, I think it's the question is really, asking the question, I guess, to what extent do we see de-risking given gilt yields are at significantly attractive levels? I mean, that said, as you will have seen, no doubt, gilt yields continue to be extremely volatile. And just yesterday, we've had another huge rally in global bond markets. So perhaps they weren't as attractive as they were only a few weeks ago. From our perspective, I guess all of this depends on, and it comes back to the earlier question asked by Jonathan, what is the end game? And how do you plan for that end game? And to what extent do you continue to hedge interest rate and inflation risk. I mean, I think it's fair to say that the anecdotal evidence, so not the evidence in purple just yet, because you've seen the lagged asset data, is that we haven't yet seen that hedging come through, and therefore, again, we remain cautious about the outlook, and until we see those gains locked in through a consistent sort of further hedging story, then it's really difficult to sort of lay any sort of credence on the fact that pension funds historically, when gilt yields have risen, have tended to lock in those better levels, because I think we're in a slightly different environment now where pension funds are reassessing their end games.
Thank you very much indeed, Shellen. I'm going to take one or two other audience questions now. Don't know if this one is for you, James, but do you have any information regarding the liquidity of a scheme's asset allocation?
I will take this question. Particularly because I was asked by a journalist the other day, in fact, and some of the new data that's from the scheme returns, I think Maria mentioned a moment ago, in terms of the asset splits and some more information, does help with this. So, for example, in corporate bonds, it's broken down by investment, sub-investment grade. You've got private debt in there as its own category now, and then with obviously in the presentation, I focused on equity and bonds, but the other 10% is other investments. I've got print out the purple book in front of me. That talks about cash and deposits, property, annuities, 2 new categories: diversified growth funds, absolute returns, and there's the small balancing figure. But so basically, the answer is yes. There is some more of that data available in the purple book.
Thank you. Thanks very much indeed for that, James. Another question here, not quite sure who to put this to. Can you elaborate more on the dispersion of changes in funding ratios, and is there any relationship between schemes whose position has improved the most with factors such as scheme size, status, maturity, or asset allocation, etc.? Maria, you're nodding. Is that something you can perhaps elaborate on a little bit?
Yeah, of course. I can start and others can jump in for further points. I think the asset allocation is a really key thing here. So for schemes that had a particular breakdown and quite a large allocation to bonds, they'll have actually seen potentially a smaller shift with how their funding position has changed, and that's because their assets have moved in the same way that their liabilities, which is obviously that main aim of why you'd run that hedging, because they're protecting their risks. It's been quite an interesting thing where actually schemes that haven't been investing in like that have actually seen quite a substantial gain to their funding position. Not all of them will have, but I suppose that they've now seen that gain. So what we're hoping is that maybe they'll now be considering, I'm in this better funding position, how might I want my investments to look, so that if the markets were to remain volatile and potentially come back down, they'll be in a better position and those funding gains will be locked in. It's very hard to kind of predict that, but we can always hope.
Thank you so much for that, Maria. That is absolutely great. Shellen, can I just come back to you sort of with a broad picture question? What do you think the sort of general improved funding position for schemes actually means to the PPF itself?
Well, I think it gives us, I mean, certainly, and this is slightly tongue-in-cheek, I mean, it makes my job as the chief actuary, I guess, a little bit easier, in that, the defined benefit pension fund universe poses less risk to the PPF. And so that is gratifying on the one hand. I think on the other hand, I guess pensions has never been more exciting than at the present. And I think it comes back to our earlier discussion around endgame planning. And, we wait to see how some of the questions that I think all pension funds and consultants are asking themselves in terms of what is their end game strategy? How do they, effectively manage themselves until they can pay the last pension? And what are the variety of options that they may choose to take up? And I think it's only once the dust settles on those discussions, which I think will take us at least another 18 to 24 months, will a clearer picture begin to emerge for how the PPF may play a role in that.
Thank you, Shannon. Thank you very much indeed. We're coming to the last segment of our webinar. I just want to ask each of our panelists sort of to talk about their biggest takeaway from this year's Purple Book. I have to start somewhere first. Maria, can I start with you, please?
Yeah, of course. So I would actually just use this as an opportunity to encourage as many people as possible to dive into all of that detail that we include within the Purple Book. It has such a breadth of information about the scheme universe, looking at maturity, assets, such a wonderful scope, how schemes look, and really enjoy looking at those trends. I'd also say this is a document which is aimed to be helpful for obviously us, but as well for the industry. So if there is anything that you'd ever want to start seeing within the Purple Book, or any ideas that you might have, I'd just say, feel free to reach out. We'd always welcome any insights and thoughts that you may have.
Thank you so much, Maria. Aaron.
Oh, okay. Well, so I'm an actuary, so obviously, my takeaway is going to be actuary related. And so I think for me, probably the most interesting has really been on the funding side. So when you get a chance to look at that chapter, but what we've seen for our estimates of the buyout funding levels has been very marked. So I think last year when we looked, only around 10% of schemes had over 100% funding on the buyout basis. But now when we look at it, and bear in mind this is an estimate, but it's now around over 50%. So what I guess that could mean is that a lot more schemes are, able to buy out. And I think, perhaps that's been reflected when we see how buoyant the buyout market is. So for me, that's probably the most interesting thing.
Thank you. Thanks very much indeed, Aaron. James.
I'd be lying if I said I don't sort of enjoy a small win from time to time, but as I was going through the Purple Book and using the new data from the regulator and the scheme returns, particularly data that wasn't there before, and having to come up with some new charts to show it. So it goes back to the more granular asset data that's been mentioned several times. So those new charts in chapter 7, I'd love it if people were to be able to get more out of those, presenting that new granular information. I mentioned the asset tiers earlier and how the data breaks down between those tiers. So again, a couple more charts around the Purple Book for that. So yeah, I hope people enjoy some of the new stuff.
That's super. And last but not least, Shannon, your sort of key takeaways from the Purple Book.
Yeah, thanks, Jonathan. Before I do that, let me just say, in much the same way as the expression, it takes a village to raise a child. It takes an army to produce the Purple Book, and I just want to express my immense gratitude to everyone here at the Pension Protection Fund and our partners, for example, at the Pensions Regulator, who we rely on for data. For the immense effort. The team here, James, Aaron, and Maria, you've met, but there's an army of people, our communications team, as well as more actuarial people behind the scenes who produce the Purple, and it's just been an honor for me to be able to be part of Purple this year. So thank you very much. In terms of key takeaways, maybe perhaps an anecdote I might share with you. Many of you will be familiar with all the variety of league tables, school league tables that tend to be published. Perhaps none more famous than the Sunday Times Parent Power table, which was published, I think, 2 weekends ago. I was intrigued to see that the top independent girls' school was a girls' school in Surrey, and as I dug deeper, I established that the headmistress had just been appointed in September this year. And I was saying to my daughter last night, and this is an actual conversation, don't ask me how we got onto the topic, but the conversation went something along the lines of, well, you see, this headmistress has what I would call an asymmetric risk return profile. There is absolutely no way she can rise up in the school league tables. The only way, the only way is down, quite frankly. And so, you know, it's very asymmetric. I guess as I joined the PPF here in the summer of 2023, the defined benefit pension fund universe has never been in a better position. The PPF is in a strong financial position, and so you know you feel an immense responsibility, I guess, to make sure that here at the PPF, for the 9 million members, approximately 9 million members that we do provide protection to, that at this important crossroads, you know, we sort of pause and reflect on the variety of options and do everything we can to make sure that we maximize the protection for the 9 million members that that the PPF was set up to protect. And so that really is my key takeaway. A rising tide has lifted most boats, and let's try and make sure as an industry that that we keep it that way. Thank you, Jonathan.
Thank you very much indeed, Shellen. One final question, if I may, to you, Shellen. In the recent autumn statement, the Chancellor announced the government wants the PPF to take on a new role as consolidator of DB schemes. Two questions. Firstly, what do you think that will mean for the PPF, and is there any sort of insight as to how many schemes in the universe might be suitable for such a role?
I think the PPF has always been clear that you know the investment made in the infrastructure at the PPF means that the PPF has the skills and capabilities in order to be able to play a wider role. I think that you know what has been announced with the autumn statement is a consultation about the way forward. The PPF acknowledges that there are a variety of ways forward in order for us to make sure that the 9 million members that we aim to protect are best provided for over the coming decades. And the PPF stands ready to play the role you know that is needed in order to make sure that particularly the pension funds that may not be able to achieve their particular end game strategies for whatever reason, you know, is that we are here to play that role. I think in the autumn statement, it was, you know, it was talked. What was mentioned was miscellaneously unattractive schemes as well as smaller schemes. We have seen, you know, some inability by smaller pension funds, in particular, to access a full variety or full suite of solutions. I'm not saying that solutions don't exist or that it isn't possible through innovative means to reach your end game strategy. I'm simply suggesting that there could be a way to improve things for those pension funds. And so, you know, I think the PPF, you know, welcomes and embraces the role that government has laid out for it, potentially in the autumn statement.
Well, thank you very much indeed for that, Shellen. I'm afraid that's all the time we have for in this webinar. All that remains for me to do is thank our speakers and panelists, Shellen Bhagwan, James Emmett, Aaron Pang, and Maria Rainey for taking part, and indeed thank all of you for viewing. Please do join us for our next webinar soon. Thank you very much indeed. Thank you.